This is going to be how to invest in real estate for passive income, 5 paths to choose from. Want to make money while you sleep? Sounds too good to be true, right? Well, it's not. If you're investing in real estate for passive income today, I'm going to show you 5 credible ways to turn real estate into a cash machine that works for you 24/7. And I bet you might think it's only for the rich or those that extensive knowledge in real estate, but that's a big mistake. Let's debunk some of those myths and set you up for financial freedom. Imagine waking up to alerts that money has been deposited into your account. Earnings from your real estate investments, that's the reality for many who've chosen to invest in real estate wisely, but not long ago, like many, I thought passive income from real estate was out of my reach, reserved for tycoons or professional investors. Then I met Jenna, who started with a single small rental property and grew her portfolio to generate a 6-figure income annually. Today, I'll share the same strategies that transformed Jenna's life and can change yours too. Buy and hold residential properties. First up, the classic buy and hold. This strategy involves purchasing residential properties like houses or apartments and renting them out. Over time, not only do you earn rental income, but you also benefit from property value appreciation. It's a long-term play that provides steady income and can be a solid foundation for your investment portfolio. Investing in residential properties for the long term is one of the most common and reliable methods to generate passive income. The key here is to select properties in areas with a strong track record or rentability and potentially for property value appreciation. This could mean buying in an up-and-coming neighborhood or established areas with steady demand. The initial process involves thorough market research, securing financing, purchasing the property, and then finding the right tenants. Over time, the rent collected should cover the mortgage taxes, insurance, and maintenance, while ideally leaving a profit margin for you. To optimize this investment, consider factors like property condition, local school ratings, the neighborhood safety, proximity to amenities like public transportation, shops and restaurants, as these attract long-term tenants. Additionally, effective property management is crucial. Many investors opt to hire a property management company to handle day-to-day operations, tenant relations, and maintenance. This can be especially beneficial if you're not local or prefer a more hands-off approach to your investment. Tax benefits are also a significant advantage of this investment strategy. As property owners, you can often deduct expenses such as mortgage, interest, property tax, operating expenses, and depreciation from your taxable income, potentially reducing your tax burden. Properly managed, buy, and hold residential properties not only yield a regular rental income, but also serves as a long-term investment through capital appreciation, providing a twofold financial benefit. All right, we're going to add a little bit about vacation rentals. Next, let's talk about vacation rentals with platforms like Airbnb, VRBO, or Booking.com. You can turn any property into a short-term rental, as long as it's legal based off the state and the county regulations. This strategy can yield higher rental incomes compared to long-term leases, especially in high-demand tourist locations. It requires more active management, but the returns can be significantly rewarding. Vacation rentals represent a lucrative avenue for real estate investors, especially in tourist-heavy destinations. Properties in such locations can fetch significant higher rental rates per day compared to a standard residential rentals. The rise of platforms like Airbnb, VRBO, and Booking.com has made it easier than ever to reach potential renters and market your property globally. This strategy requires significant pricing strategies and excellent marketing to stand out in competitive tourist markets. However, vacation rentals also demand a higher level of involvement and management. Investors need to ensure that the property is well maintained, is furnished, meet tourist expectations, and regularly clean. Utmost important is the cleanliness. If you want to have and maintain a certain level of clientele, cleanliness has always been the top of all of my reviews that I've received from my properties. So if you want to stand out, you gotta be very overt on your cleanliness. It's gonna attract those certain people and gonna pull in that additional income that you're gonna be looking for. Additionally, customer service becomes a priority, as positive reviews can significantly impact future bookings. It's also important to stay compliant with the local regulations, which can include restrictions and taxes specific to short-term rentals. Now, I mentioned earlier that customer service, but you gotta also understand in the short-term rental field, you're more of a hospitality. You're providing a service to your guests. So you got to think of it not from an investment portfolio, but at that point, now you're going into hospitality, understanding how to make someone feel welcomed and invited, and that they're on vacation, always understanding that they want to see something different than where they came from. What can you provide to them that they would not have at home already? What experience can you provide for them that they can't get at home already? So that's what I would tell you to look at. Now, with the financial returns of vacation rentals, it can fluctuate seasonally. So it's important to calculate the potential off-season versus peak season earnings to ensure overall profitability throughout the year. Successful vacation rentals investors often diversify their holdings across different markets to mitigate the risk associated with seasonal demand fluctuations. So with that, you can possibly look at either doing mid-term rentals mixed in with your short-term rentals because you have furniture in your rentals. That's some of the things that I look at doing. So if I have a low season for that area, I may advertise more to my traveling nurses, my traveling professionals, contractors that's moving, or personnel that's doing internships. Those are I would push for during those off seasons. That will keep you at a higher state than even long-term rentals. Moving to commercial side. Now, commercial real estate, this includes office spaces, retail locations, and warehouses. It's a different game with higher stakes and bigger payoffs. Leases are longer, which means stable long-term income, plus tenants often pay for maintenance, taxes, and insurance, reducing your overhead costs. Commercial real estate is a broad category that includes office buildings, retail spaces, warehouses, and more. This type of investment usually requires a larger initial capital outlay, but offers attractive returns due to higher rent prices and longer lease terms, which provide stable and predictable income streams. Tenants in commercial properties often sign multi-year leases, which is great. And it's common for these leases to include built-in rent escalations, ensuring that increment growth in rental income. An appealing aspect of commercial real estate is the triple net lease, where the tenant is responsible for most expenses associated with the property, including maintenance, insurance, and taxes, which reduces your financial burden on the investor. This can significantly simplify the management responsibilities and financial planning for the property owner. However, commercial real estate investments are sensitive to economic conditions, and vacancies can be longer and more costly due to the specialized nature of the properties and the smaller pool of potential tenants that's trying to rent it. Investors interested in commercial real estate should conduct thorough market research and property analysis, understanding local business trends, and consider the economic forecast when selecting the properties. These factors influence tenant retention and the overall success of the investment. Moreover, building relationships with the business tenants and understanding their needs can lead to longer term leases and reduce. For those that prefer a hands-off approach, we're going to discuss real estate investment trusts. All right. You invest in real estate portfolios managed by professionals. So the portfolio itself, the real estate investment trusts often offer high dividend yields provided by liquidity that direct real estate investments don't. It's real estate investing with stock market flexibility, pretty much. It's kind of like real estate investing like as a stock market game. They offer a way to invest in real estate without having to buy or manage any property directly. These trusts pool money from multiple investors to purchase portfolios of real estate assets, which can range from apartment complexes and shopping malls to hospitals and data centers. These trusts are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, which can provide a steady income stream for investors. One of the primary advantages of the investing in the trust is liquidity. Unlike direct real estate investments, shares of publicly traded trusts can be bought and sold on major stock exchanges, offering flexibility and ease of entry and exit that direct property investments do not. This makes trust an attractive option for those who want exposure to real estate without the illiquidity typically associated with owning physical properties. However, since these trusts are traded on stock markets, their prices can be volatile and influenced by the market fluctuations, similar to stocks. Investors in the trust need to perform due diligence just as they would with stocks, assessing the trust, assess quality, management quality, and the dividend yield history to ensure it aligns with their investment goals and the risk tolerance. Now, lastly, real estate crowdfunding. This path allows you to invest in real estate projects with small amounts of money by pooling funds with other investors. It's great for those looking to get started without hefty capital and offers exposure to a larger project otherwise inaccessible to individual investors. Real estate crowdfunding has democratized access to real estate investing, allowing individuals to invest in real estate projects with significantly less money than would be required to buy properties outright. Platforms that facilitate real estate crowdfunding enable investors to choose specific projects to invest in, from commercial developments to residential rehabilitations, and share in the profits generated from these investments. This form of investment allows your portfolio diversification and risk spreading across different types of real estate projects and geographical areas. Investors can select projects that match their risk appetite and investment time frame. From short-term flips to long-term development projects, crowdfunding platforms also provide detailed information on each project, including expected returns, project timelines, and background information on the developers, which helps investors make informed decisions. However, real estate crowdfunding is not without risk. These investments are usually illiquid, meaning that your money may be tied up for the duration of the project without the option to easily withdraw early. Additionally, as with any investment, there is no guarantee of the return, and the projects may fail to meet financial projections, affecting profitability. Therefore, it's crucial for potential investors to thoroughly research and understand each project and platform before committing funds. Furthermore, real estate crowdfunding is relatively new and operates in a regulatory environment that is still developing. Investors should be aware of the legal and regulatory framework in which these platforms operate and understand how it affects their investments. Additionally, because crowdfunding platforms vary widely in terms of project types and management expertise, it's critical to evaluate the track record and reliability of the platform itself before investing. Investor engagement and project selection is unlike traditional real estate investment, where the property is the main focus. With crowdfunding, the project management team and business plan are equally important. Investors should look for transparency in how projects are selected, managed, and reported on. Effective communication between the platform and investors regarding the progress and any changes in the project is crucial for trust and engagement. Risk management. To manage risk associated with real estate, crowdfunding diversification is a key. Just as with stocks and bonds, spreading investments across various projects, locations, and types of the real estate can help mitigate potential losses. Additionally, understanding the exit strategies for each investment and the platform policies regarding failed projects or delays can also provide clarity and confidence in decision making. In summary, real estate crowdfunding presents an accessible entry point for individuals looking to participate in larger real estate ventures, traditionally reserved for well-capitalized investors. It offers the potential for significant returns and valuable diversification benefits. But like all investments, it requires a careful consideration and management of expectations and risk. By exploring each of these 5 paths to invest in real estate, your passive income investor can find the strategies that best fit their financial goals, risk tolerance, and level of desired involvement. Real estate remains a powerful tool for building wealth and generating passive income, but success relies on a thoughtful, informed approach to selecting and managing investments. Whether through direct property ownership, trust, or innovative methods like crowdfunding, the opportunities to grow and sustain wealth through real estate are vast and varied. Remember, the key to successful real estate investment is not just choosing the right properties, but also managing them wisely, adapting to the changing market conditions. So there you have it. 5 viable paths to generate passive income through real estate. Whether you want to be hands-on or prefer making your money work for you from afar, there's an option that fits your lifestyle and budget. Remember, each of these paths, its nuances, and success requires understanding and strategy. If you found this guide helpful, like and subscribe for more insight content. And don't stop here. To dive deeper into maximizing your real estate investments, check out our next video, short-term versus long-term rental investments.